brand new show of Markets and More. And it gives me great pleasure now to bring on board Sunil Singhania. On Markets and More, we would be discussing, ideating and understanding from Sunil the way forward for Indian markets, the way forward for the economy, and why are markets stuck in this kind of a range. And for those who are losing patience because last 12 to 18 months markets have not given any returns, is it time to start focusing and thinking of alternatives? Well, if you got equity long-term bull on TV, we all know the answer is that keep the faith and this shall also go. But why has there been a change in terms of the market participation and the level of interest? All that and much more on this edition of Markets and More with Sunil Singhania. Sunil, fantastic to have you back on ET now. Thank you for joining us.
Good morning, Nikunj. Pleasure being here.
There seems to be a change, and there seems to be a change in terms of approach, projections, outlook, and also participation for Indian equities in last 3 to 6 months. One side, all the concerns which were there in the world, they are getting addressed, yet there is no clear pattern at play. Why is that? And how long do you think this dull market will continue?
Hi. Actually, if you see Nikunj, I think the market made its near-term peak somewhere towards the end of 21. And though 22 started with a lot of concerns, particularly pertaining to the Russia and Ukraine issue, I think for the first 6 months, we did not see too much of a impact of that, at least on Indian economy and demand. In fact, demand continued to be quite buoyant post the reopening of COVID. However, what you have seen over the last 2 quarters is companies facing headwinds, particularly in terms of margin. There have been massive swings in raw material prices, which shot up post the Russia-Ukraine issue and then came down sharply. The same thing was the case with energy and also logistics. At the same time, obviously, inflation in the Western world seems to be a little bit more sticky than what people made out to be. And on top of it, in India, we had an uncertainty about, one of the large groups facing some issues in terms of stock prices falling. So I think all in all, it has been, I would say, a nervous last 3-6 months, where overall, I think on the headline side, markets haven't been as bad, but broader markets have seen quite a decent correction. So it's been a nervous and a listless kind of a market, I would say.
So what do you think will be the out of jail card for the bulls?
So Nikunj, I think markets always have a reason to surprise. I mentioned to you about some of the headwinds. I think most of these headwinds are becoming tailwinds. So, for a lot of sectors, raw material prices have come back to normal. Energy costs are coming back to normal. And in fact, many sectors are benefiting from the sharp drop in logistics cost. Demand in India particularly continues to be quite buoyant. And though there is this small fear of El Nino, which might impact monsoons as we move forward, I think the winter crop has been very buoyant. We have had record production of agriculture as per the initial estimates. And prices are pretty decent, so farm income should be very good. The Indian, urban side also seems to present a fairly stable and a decent picture. We have a very, I would say, busy marriage season ahead of us. So I think all in all, the Indian economy seems to be in a much better situation. As far as the world is concerned, I think the world has been swinging, particularly on the back of what is the outlook as far as interest rate and inflation is concerned in US. So I think 15 days back, there was a risk on because yields fell from 3.9 to 3.4, and then suddenly last 15 days, the outlook on interest rates have again started to go on the reverse, and we have seen 10-year yields shoot up to 3.9. So we are in a yo-yo kind of a situation where risk off and risk on nowadays happens in like a month rather than 6 months or 12 months, which you used to see. But I would say that, after the initial sort of nervousness, we are heading into a space where, I would say good news can sort of, outpace the bad news.
For news to have impact on stock prices, the margin of safety has to be strong and relative valuations have to be attractive. So if the news changes and if the headwinds they become tailwinds, do you think markets are now factoring, I mean markets are now attractively positioned in terms of the valuation setup?
So two things have happened, Nikunj. One is obviously the markets have corrected. So I think over the last 15 months, markets have in fact been down on a headline basis by almost 8-9%. Broader markets are down, as I said, 20-30%. And we have added to the earnings. So the huge overvaluation which India had vis-a-vis the world is narrowed to some extent. The second thing, I mentioned, September and December quarters were not great for quite a bit, for quite a lot of sectors. Though on an overall basis, Indian corporates did pretty well in earnings, led by the financials in particular. But I think as we move forward, I think March earnings will normalize and June can be a better quarter. And I think to that extent, if we just start to discount FY25, which would become the 1 year forward, suddenly Nifty would look like around 16 and a half times earnings, which is what the 10-year long-term average is. So I think from like 21, 22 times which we are looking at in the next 3-4 months, we should be start looking at Nifty earnings trading at Nifty markets trading at around 16 and a half times earnings, which is in line with the long-term trajectory. So I think that should be good. And on top of it, my view is that the world also should stabilize. The headwinds which the world faced in terms of high energy cost, particularly in Europe, which led to lowering of demand and a lot of again companies going out of production, is slowly coming back to semblance. There was this initial fear that the world might go into a recession. Now the IMF forecast itself clearly point out that there are hardly any countries which would have a recession. Most of the countries will grow, albeit a little slowly. And then you also have the Chinese economy opening up post the new year. After 3 years, you will have a normal Chinese economy, and that should pull the global growth back to a little bit of an upward trajectory. On an India perspective, I think obviously the foreign investors have been selling in India for the last 18 months again. They turned buyers towards the end of 22. However, some events have led them to be again small sellers. But as we move ahead and the indications which we get when we speak to our friends overseas and when we interact with prospective global investors, our view is that second half should see a good amount of inflow, which should more than offset the outflows which you have seen in the first 2 months. So I think overall a mix of global markets and economy stabilizing. I think Indian earnings coming back to normalcy for the broader sectors, and also flows turning positive. They all should basically aid, and the fact that valuations are now not as expensive should also lead to stability and an up move returning back to the Indian markets.
If I look at your last declared portfolio, the January portfolio, which is there in the public domain, there are 2 banks right up there, ICICI Bank and State Bank of India. Now, banks have done well, numbers from banks have been strong, NIMs have been decent. But is this the best what we will get from banks from a long, long time? Because deposits are low, credit offtake is strong, which means either margins will get compromised or growth has to be compromised.
So Nikunj, that is the beauty of the markets. I think January saw the best results from banks, but even then, year to date, banks have been one of the worst sectors in terms of movement. And largely a function of what you mentioned, people are expecting that this is the peak as far as earnings is concerned. And also, obviously there was some collateral damage expectation from what was happening in terms of one large group. However, having said that, if you see, what we are heading into, so the retail side of the credit demand is strong. And for a change, you also have now the capex cycle picking up, and you have corporate demand for credit also moving up. Yes, there will be some impact of the liability cost moving up because FD rates have moved up. But, I think in India, on a percentage basis, the increase in interest rates has been much more narrower. So in US, from 1% to 4% is like 300% increase. In India, from 6.5% to 7.5% is like 15% increase. And I think to that extent, 50, 75 basis point passing on is not an issue. Credit costs have never been so good. And I think a function of all these make us believe that at least for the next 2-3 years, banks and financial services are poised for a good show as far as earnings is concerned. And stocks are not exorbitantly cheap. Obviously they are trading at higher multiple than what they were maybe a year or two back, but they are still trading at around book for a few banks and just around 1.5, 2 times for quite a good number of good quality private banks. So we continue to be quite optimistic on this segment.
So what do you think should be the projected return from banks from here, next 2 or 3 years? If one assumes that credit growth of 12 to 15% is here to stay, do you think banks will compound in that same with that same rate?
$1 million question, Nikunj, but just a disclaimer which I always give, I've always been an optimist on Indian markets, and I continue to remain so. And I think banks and financial services are an integral part of any growing economy. So, if our view of banks, the balance sheet growing at 12-13% would mean that profits can grow a higher 17-18%. And because they are I would not say they are, they are at a decent valuation, like they're not overvalued. I would say that returns should mimic at least the profit growth.
What is your projection for profit growth for next 2 to 3 years? Because for last 2 quarters, what we've seen is earnings downgrade, not an upgrade.
No, for banks, earnings have been upgraded. Yes, generally for the corporate India, as I mentioned earlier, there were headwinds for quite a few sectors in the September and December quarters, and we have seen some downgrades. But I think overall for corporate India, we still continue to be quite optimistic of a 15-16% earnings growth for the next 2 years. Obviously, 24 would be led by financial services, where the earning trajectory would be higher, but other sectors would catch up, over the next couple of quarters. And Nikunj, we also have to keep in mind that 24 is an election year, and historically we have seen that both consumption as well as capex on the government side picks up in the run-up to the election. So I think that should also be a tailwind as far as the growth in the economy and corporate profit is concerned. The other thing is, some sectors, some companies which had an exposure, particularly to Europe in terms of exports, have suffered last 6 months, and now Europe is slowly starting to get its feet back, and that also should start to become less of a headwind in the next couple of quarters.
From a market standpoint, do you think the sell-off in Adani group of stocks is something which is well digested?
So I would not like to comment on that, but see, I think at Abacus we have always followed the discipline of valuation, and it's not only this group but a lot of other stocks which have great quality but priced beyond perfection, which is what makes us a little bit of having a value conscious approach, and I think that is what we have continued to follow.
My question was that from a market standpoint, do you think the selling in Adani group of stocks and the domino effect, let's say, created on lenders and other banks, do you think that's behind us?
So, time heals and time makes us forget a lot of things. We are already, I think, 1 month into the process or the news flow. I think a lot of water has flowed below the bridge. I don't know whether this is the end of the news flow, but I would say that markets over a period of time, as has been the history and I would say experience earlier, tends to sort of make it less and less relevant as we move forward. So maybe it was very relevant towards the end of January. It is relevant maybe today, but not to the same extent it was January. But I think with time, markets will forget and move on.
When we spoke a couple of months ago, you did call out that private banks and small mid-tier banks were looking cheap, attractive, and they were growing and their balance sheets were in a fine fettle. Some of these banks have rallied even after the recent underperformance on an average 30 to 40% in last 1 year. Do you think that now small and mid-tier banks are no longer cheap?
No, Nikunj, I think, make the mistake of just looking at very near-term performances, both on the upside and downside. So smaller banks have done well last 1 year, but for the previous 5 years, they have done nothing. I would say that some of these banks have transformed themselves, in terms of adoption of technology, in terms of moving to better practices, in terms of lending as well as attracting customers. And some of them still look pretty reasonable given their faster growth trajectory. At the same time, I think in banks, one has to be now a little bit more choosy in terms of bank to bank. You can't classify the larger banks in one basket, the smaller banks in another basket. I think you'll have to pick and choose because the trajectory of asset quality and growth can be very different for different banks. And here I would say that banks who are a little bit forward-looking are the ones which should be preferred over banks which have been a little bit late in terms of technology adoption.
Sunil, a year ago, consumer tech and fintech stocks were trading in bubble zone. A month ago, they had come down to levels what could be called as a fear zone. How are things looking for the entire consumer tech and fintech? Because most of the promoters I have met and we've interacted with are of the view that the path to profitability cannot be compromised now.
So, I think first on the technology front, great entrepreneurs, great companies, hats off to them. They have created segments which did not exist, businesses which did not exist, given employment to so many people, make our life so easy, in terms of whatever we do on a day-to-day basis. Having said that, I think these investments are for investors who understand these businesses and are willing to take a 10, 20-year call in terms of growing the business and profitability. As I said, we are value-conscious investors, and we don't invest in companies which don't have profits or don't have visible profits. And I think most of them still don't have visible profits. Obviously, there are a couple who are on the fringe of seeing profits. And I would say that as the markets get more and more comfortable on their road to profitability and self-sustenance, then more and more investors will look at it. Nikunj, what happens is a lot of these companies depend on regular capital infusion to just sustain. I think those companies are definitely at risk because if capital dries up, then their existence itself will be at risk. But companies which can sustain through at least internally generating what they need to grow, I think those companies have a better chance of surviving and maybe even thriving. As far as consumption companies are concerned, the whole concept of growth, growth means that you have to grow at a faster pace than the nominal GDP growth of the country. A lot of these consumption companies trading at 70, 80 PE were growing in line with the nominal GDP or even less. And I think the markets have lost patience because of the last 2, 3, 4 years of them constantly, disappointing on growth. And to that extent, there has been some price correction and some time correction. I think going forward, there is a little bit of room, more left, maybe both time as well as price correction. And then, a lot of them have great franchises, great brands, and they will become really attractive.
So can I say that when the selling or when we saw a real selling stampede in some of the consumer tech and fintech stocks, as a fund house, you did not participate in them. You've not bought any of the new tech companies.
So, Nikunj, it's very easy to get swayed by price movement and say that this stock has fallen 50%, let us buy it, and this stock has fallen 75%, let us buy it. But as I said, we are looking at investing as if we are becoming partner in the businesses, and therefore our horizon is 3 to 4 years. So there are 3 basic rules which we follow. One, the company has to be profitable. Second is there has to be visible profit growth, maybe doubling of profit at least in 4 to 5 years. And the third is, what we pay today should be more than repaid to us by way of future profitability. I think most of them still don't fulfill these 3 criteria. And therefore, at least for us, just because a stock has fallen, do we buy it? I don't think that is what we follow.
So where do you see this combination working, where you are conscious of profitability, where you think the profit in 3 to 5 years should at least double? That's a threshold, and they should give you a decent entry point. Where do you think this combination is at play for you?
I think that's an ongoing exercise on a daily basis. Our battery of research analysts keep on digging it and meeting companies. But Nikunj, what has happened is obviously there are companies who did very well, and then last 1 year there has been suppression in terms of earnings because of huge movement in commodity and input prices. But a lot of them have cleaned up their balance sheets quite substantially, and they have emerged very strong. So I think the next leg of winners would be companies who have used this bounty of profits which they have made over the last 2-3 years to make their balance sheets very light in terms of debt. So there are quite a few. I think metals look pretty decent, and particularly after the recent short-term correction, I think China opening up is for real, and there should be some demand coming in from metals. Chemicals was a very hyped sector, particularly specialty chemicals. I would still say that a lot of these companies are still pricey, but some of the non so-called specialty chemical companies are coming back on to good levels. Same is the case with pharma. I think underperformed big time, but a few pharma companies have started looking pretty decent. And the mid-cap IT pack, maybe, if you have a small correction further from here, they would start to look pretty exciting. Also, some of these building material companies have suffered because of massive input cost increases, and stock prices to that extent have corrected. I think that's a long-term trend, with more and more housing in India. Some of these building material companies also look pretty exciting.
Sunil, let me draw your attention to slowdown. Consumer companies are complaining there is a slowdown. IT companies are already starting feeling the heat. Layoffs have started in the startup world. Most of the middle of the pyramid or bottom of the pyramid categories are contracting. Do you think this is temporary in nature?
No, you are right. I think this whole talk about the K recovery has been for real, at least in the last 1-2 years. So, the upper end have been spending like crazy. We don't have rooms in hotels. The ARRs have moved up, flights are full, and so on and so forth. And as you rightly said, on the lower end, there has been a demand compression. But I think that should change for a couple of reasons. One is now we have a normal economy. So at the lower strata of the society, I think there are no further job losses. In fact, there is an improvement in job opportunities. Construction is picking up pace. It's a big employer, at the lower level. As I mentioned earlier, farm income should pick up quite nicely once this winter crop is harvested, because both the produce as well as prices are at record highs, and that should do well. And in the run-up to the election, normally, you have the economy picking up pace, and there is a multiplier effect which impacts the lower strata of the society much more. So I would be more constructive over the next 6-12 months that the slowdown in demand, particularly at the lower level, should start to equalize. Already when we speak to companies, I think steel, cement, we are seeing good demand. And that is an indication that the capex as well as the infrastructure side is picking up pace. Government's allocation for this year is at a record 10 lakh crore as far as infrastructure is concerned, and that again has a multiplier effect of at least 4-5x of what the government spends. So we would be constructive. I think things would start to fall in place.
All right, there you have it. Sunil Singhania sharing his outlook on the markets. Tell you what, we'll take a